Thank you for joining us on Minds of Commercial Real Estate. Today we have Gian Pazzia from KBKG. He is the co-founder and chairman. They are a cost segregation firm. Gian, thank you for joining the show.
Yeah, super excited to be here, buddy.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Yeah, I was really looking forward to the show, you know.
Yeah, I know. It took a little time to get it scheduled,
Absolutely.
but I'm here now.
Yeah, absolutely. Good to have you here.
Yeah.
So we want to go review the cost segregation and how, how it applies to different residential properties, being investment or any type of commercial property, and the benefits to the borrowers who have these types of properties. So I'll let you deep dive into the niche and nitty and gritty and go over the details.
Yeah. Should I tell a little bit about my background
Sure,
and my
absolutely.
company? Yeah. Okay. So I'm an engineer by trade. I graduated from Purdue many years ago, and I fell into the world of tax and accounting by working at Arthur Andersen back then and doing cost segregation studies. So people might not know if they're younger who Arthur Andersen was, but they were like the biggest and best accounting firm in the world. Right. Ended up going under with the Enron scandal, but ended up working for them doing these cost seg studies for huge casinos that we all know in Las Vegas, and also like these huge Fortune 500 pharmaceutical companies with big plants that needed to be segregated. So did that for several years out of Chicago, came out to California, founded KBKG. This was back in 1999. And we've grown to be, if not the biggest cost segregation firm in the country. We do probably 3,000+ studies a year. And that doesn't even include the studies that are being done using our self-guided software. I mean, there's probably another 1,000 easy there. And we can talk about that later. But yeah, so KBKG was founded 25 years ago. There's me and my co-founders. And we've grown. We have about 160 employees with brick and mortar offices in New York, Atlanta, Dallas, Houston, Chicago, Detroit, and Los Angeles. I'll talk a little bit about what cost seg is for those that maybe don't fully kind of understand it, probably heard it at a cocktail party or maybe by their accountant. But cost segregation is a way for real estate owners to speed up how fast they're going to write off certain parts of their building so that they can save that money for tax purposes. So normally when you buy a building, right, the step one is you have to separate the purchase price from between land and building, okay? And the land, you're not supposed to write that off or depreciate it, okay? So you have to separate that, and what's left, the building value, you get to write off over 27 or 39 years, depending on the type of property it is. And so what a cost seg specialist does is goes into the property and measures and counts all the different components inside that building that fit into these categories that you can write off right away. And so we're talking about things like, if it's a residential rental property, vinyl plank flooring, maybe ceiling fans, things like the cabinetry, the appliances, and even the piping and wiring connected to these appliances, okay? And then a lot of the stuff outside the walls of the building, like your driveways and landscaping, right? All of that stuff, okay, right now can be written off right away instead of dragging it out slowly over 27 and 39 years, okay? And so you get this huge, by doing this study, you get this huge pop of significant depreciation in year one that allows you to sometimes wipe out all your taxable income and use that money to invest in growth elsewhere. I know that was a mouthful, but to put some numbers to it, let's say you bought a $300,000 rental home. Step one, how much is the land worth? Let's say that's worth $30,000. And what's left is the building, $270,000. Okay, you're supposed to write it off over 27 years. So you get to take a $10,000 deduction each year for 27 years, right? That's without cost seg. With cost seg, you can get as much as 25% of that $270,000 in year one. So now that's $54,000 of deductions in year one versus $10,000. That's a $44,000 delta. And that's really where the value is capturing that and using it to not pay your taxes, not overpay in taxes.
Right. Why would somebody do a cost segregation? What are the benefits?
Yeah, I mean, really, it just comes down to not paying tax, right? Because these rules are in the tax code, and sometimes people, a lot of people don't realize that you can separate the components in a building, and they just end up paying more tax than they should, right? And so there's a lot of reasons to do a cost seg study because of the tax savings, but it's probably easier for me to tell you why you shouldn't do a cost seg. You shouldn't do a cost segregation if you can't use all these extra deductions against your income, okay? And this is why you need a CPA sometimes to advise you on whether it's right for you, okay? If you're in a situation where maybe you're a software engineer and you make $300,000 a year and you decide to go buy a rental property, long-term rental property, you're considered a passive investor, okay? In that situation, if you create a bunch of losses from that rental property, let's say it was 54,000, like my example.
Sure.
You might not be able to use you wouldn't be able to use any of those losses against your income from your software business. Okay. So then the question is the property that you're buying, does it need more deductions to cover the income it's generating? Okay. So sometimes it does. Sometimes you need more deductions. A lot of times in the early years, you have enough depreciation and interest expense to cover the income that you're getting from that property. And so that's a situation where cost seg may not make sense. But yeah, it comes down to your tax situation and whether you can use those deductions. Yeah, there's all types of things we can get into about strategies to be able to use them, but that's the general rule.
How many? So every building you can do cost segregation on it once, correct?
That's right. It's a one-time deal. You know, when you buy a building, if let's say you paid $5 million for it, $1 million of that might be land. You got $4 million left. That's all you get to depreciate on that building. The question is when are you going to depreciate it? You can, do it all over that 39 years, in which case it's just a slow burn and then all the depreciation's gone. Or you can take a bunch of that up front. But yeah, once you segregate and accelerate and take it, you're not doing a cost seg study on that again unless you made significant improvements to that property, in which case you can still do a cost seg analysis on the improvements. Yeah.
Now, can you do I'm just trying to get the more information to the viewers and like different buildings. Like if you have say 5 buildings and you're not aware of cost segregation, can you do the cost segregation on all 5 buildings in 1 year and use them?
The one thing that's nice about cost seg, which isn't always the case in the tax code, is that you can actually time when to use it. So you bought the study this year and you don't have tax liability this year, like you just don't need more deductions. You don't have to do the study this year. And you could wait and see how your income's going to look next year or the following year. And whether it's 2 years from now, you have, let's say you're selling a property in that 3rd year and you know that there's going to be a bunch of income that you have to pay. Well, now let's go do the cost seg on the other property in that same year of the sale. So you create, let's say, $1 million of deductions to cover, maybe you had $1 million gain on a property that you're selling.
Okay.
But yeah, you can do all of them at once, but yeah, it's usually dependent on how much do you need,
You could strategize it.
Yeah, exactly. Don't do all 5 if you only need to do 1 to cover your taxes.
Understood. Got it. I have many clients that just, based on cost segregation, every 2-3 years, they buy a new building to be able to do a cost segregation and, be able to pay lower taxes with IRS codes.
Yeah, that's the thing. It's kind of like a drug. Like once you start doing it, it's hard to stop.
Right.
Right. And it's because high net worth individuals that have income from other businesses or maybe income from properties that they've owned, right, that have been fully depreciated. It's time to pay Uncle Sam on this income. So it is a viable strategy. A lot of real estate investors will just, instead of paying Uncle Sam $1 million of tax that they have to pay, why not take that million and put a down payment on a $4 million property or a $3 million property, get that depreciation,
Exactly.
right? Take all that depreciation to cover as much tax over here, and now you have another asset that is spitting off income. And by the way, when you're able to use these deductions, it turns the ROI, like the cap rate, if you will, here in California, sometimes they're 5%, depending on where you're buying, but it can jump that up, like that ROI to 15% in year one when you're taking this big chunk of depreciation that you get to use.
Yeah, it's an amazing tool to be used.
Yeah.
How is there a limit on the tax cost segregation amount? You can can you do it on $100 million building, $500 million building?
There is no limit. The only limit is whether the taxpayer that owns it is taxable. And so you got bigger institutional real estate deals that are funded by like pension funds, right? And so if there's a $500 million building owned mostly by a pension fund, those pension funds don't pay tax. They're not going to need or want a cost seg study in that case. But it really just comes down to who the taxpayer is, and are they taxable and can they use it?
Interesting. So you mentioned you've created a software for cost segregation. Let us know. Give us more information on that.
Yeah. I mean, everything's moving towards tech and AI, right? So we were the first company to ever create a self-guided cost segregation software that can be used online. We did this we launched it in 2016, and it was designed at the time for smaller residential rental properties. So, talking about the single family rental homes that people are buying for $150,000 in Arizona or Nevada. It just didn't make sense. It doesn't make sense to go out and hire an engineer and pay them $3,000 or $4,000, sometimes $5,000 to go look at a property that small. And so that's what we had created it for that end of the market. It only costs $500, which makes it pencil out. And so right now that tool it's called costsegregation.com. Okay, that's the website as well.
Great URL.
Yeah, great URL. And it works for any multifamily property up to $1.5 million in depreciable tax basis. Okay, what that means is if you bought a property for $1.8 million and the land's worth $400,000, your depreciable part is 1.4. That you can use our software for that. Okay. It also works for commercial properties. So up to 1.5 million in depreciable basis. So you can do things like offices, restaurants, hotels, self-storage, warehouse, etc. And so very popular tool. We've actually been under IRS audit multiple times and have never had an adjustment.
Now, what about for bigger properties? What do you have if you have a building, 2 million, 3 million depreciable, so they will need to get the actual study?
Yeah, like I said, we're one of the biggest, if not the biggest, cost segregation consulting engineering firm in the country. When you're looking at, let's say, a $10 million office building, we're going to need to send an engineer out to the property. They're going to survey it. They're going to look at the blueprints, look at the appraisals, any other documentation. They're going to walk through each tenant space and catalog all the different components that are in there. Is there a server room over here? Is there, wiring that supports that data room? That's the traditional way to do a cost segregation study because the deductions are so large that the IRS really prefers to see a qualified engineer do that type of work. And they've published multiple IRS guidelines stating that.
Okay. So if a person has built their own building and they have like a cost breakdown, that would help in your, right? They just provide that to you and you can go based on the cost breakdown after the engineer would walk the building.
That's right. Yeah. So that $10 million office building, if you got the general contractor's detailed payment application, that's a great starting point for us.
Right.
But there's still a lot of work to take what they might, I might say there's $500,000 of electrical. Well, what does that mean? So that's where we come in and start identifying those things that can be written off right away.
Got it. Okay. So what is a good example of a high net worth individual who's not really focused on, buildings or any real estate, or maybe in the tech industry or any other industry, but, they learn about this cost segregation? Do you have a good example?
Yeah, there's several strategies. So there's rules and caveats to all of this. But if you're married, if you're a tech executive founder or something, and you got all this income, if you're married to a real estate professional, okay, and there's a whole bunch of criteria that goes behind that in the tax code, and you file your tax return jointly, if you go as a couple start buying up real estate, you can create all these deductions and use those deductions against your income from your tech company. Okay. So that's a strategy. That's a legit strategy. In fact, my wife is a real estate professional, and we've bought several properties. She manages them, deals with the tenants and the repairmen and all that stuff. And there's a certain amount of hours that are required, and she tracks all of her times, make sure that we're in compliance. But it allows us to take those accelerated deductions from our real estate and use it to offset the income from my consulting business. Here's another thought and strategy. Let's say you're a founder of a business and you want to exit. Private equity comes along, makes you a great offer, and you get this big windfall of cash. Well, here's where you need to be proactive, okay? The way I would structure that situation, if you have really good advisors, is that the sale is coming, let's say in 2026, okay? You want to be able to exit that company maybe early in 2026. And let's say you got $50 million that they, threw at you for your business. You want to have enough time to be able to turn yourself into a real estate professional for tax purposes. Mm-hmm. Okay. And that, again, requires 750 hours of, real management of properties and acquiring properties, right? So if you get this $50 million windfall of income, in that same year, you're going to want to start going and buy a bunch of properties so that you become a real estate professional, so that you can use all the deductions from cost seg
across the properties
to offset this huge event, right? And another way to kind of make that a little easier is you tell the company who's buying you out to do what's called an installment sale, which means instead of giving me $50 million all at once, I want you to give me $20 million
this year,
in this first year, and then $20 million in the following year. And that just gives you more time, right? So depending on how much you're getting, and I know I'm using some crazy number, $50 million bucks, but usually exits might not be that much. But if it's a $10 million exit, right, that's, especially if it's happening in the middle of the year or towards the end of the year, like, shoot, there's no way. If you're getting that 10 million in December, like, you got no time.
Correct.
Ask for the installment sale. So that a minimum amount is in December and more of it is pushed to the following year, so you can...
That gives you time.
Gives you time to implement the strategy.
So when you do a cost segregation and you're planning on either keeping the building long-term or maybe, passing it through, your kids and everything, how does it work with estate planning?
Yeah, there's actually one really, really good estate planning strategy. Couple of things. Okay. One, if you've owned the building for many years, and let's say you're 70 years old, you buy a building, you do a cost seg on it, right? You squeeze out all the depreciation. Let's say 10 years later, you pass away, and your kids inherit the property. The nice thing is that there is what's called a step up in value to fair market value, and you get to reset depreciation over. So let me put some numbers to that. Dad buys a building 10 years ago, pays $2 million for it, does his cost seg. Now, today he passes away. The kids, if the building is worth $8 million, right? The fair market value is reset and you get to start depreciation all over as children on $8 million of basis, because that's the new fair market value. So anytime that I'm advising people that have older parents that have real estate, I always tell them it's really important that they do the cost seg study while they're alive because of that step up. And so let me give you kind of an example. So like, let's say dad buys a building 2 years ago for $10 million and you don't do the cost seg on it. So after 2 years, you might get maybe, I don't know, $300,000 or $400,000 of depreciation on that asset that dad uses to offset dad's income. If he passes away this year, and then the step up goes from 10 million to, I don't know, 10.5 million, right? Kids start depreciating it. Dad just lost the opportunity to take a bunch of deductions that he should have taken when he was alive, and it's just gone forever, right? So make sure dad or mom depreciates the heck out of it, especially when they're older, because why not? As soon as they pass away, it's going to step up. So it's kind of a use it or lose it situation.
Mm-hmm.
Okay. If they don't use it, they literally use it. And so here's what I advise a lot of CPAs, tax advisors, especially estate planning attorneys. If you have any clients that passed away in the current year, and they held real estate, okay, there is an opportunity that is extremely time sensitive. If they did not do a cost seg study while they were alive, okay, there's still time. They let's say they die today, okay, or let's say July 1st, in the middle of the year, in 2025, okay, you have until September of the following year to file that tax return, right? Because that's
Right.
the extended due date.
Right.
Even though dad passed away, he had a $10 million building. He never cost segged. He only took $300,000 or $400,000 on it, right?
Mm-hmm.
Now the kids are looking at it and saying, I'm going to get this step up. But before that tax return is filed, you can actually go back, claim the missed depreciation that dad should have taken, and make it so that could be millions, right?
Mm-hmm.
Take those deductions on dad's final tax return before he's deceased. And then right after that cutoff, when that happens, they get the step up. So you get to double dip, basically.
Best of both worlds.
Best of both worlds. You get to double dip. And it's very time sensitive. Once the final tax return is filed for the decedent, it's gone. That opportunity is gone. So it's very time sensitive to address that in that situation. If you have a recently
Very unique situation.
yeah, someone that passes away that holds real estate. Yeah.
Gian, thank you for being on the show. What's a good way for viewers to get a hold of you?
Yeah. So, our company is KBKG. So our website, kbkg.com. You can find me on LinkedIn. I'm the only Gian Pazzia on earth that exists because I've tried to look for it. So you'll find me on LinkedIn. And then if you get those smaller properties, you can find that product on costsegregation.com. And so, yeah, happy to help anyone that needs my help.
Great. Well, thank you for all the amazing information and look forward to having you on the show again.
Yeah, thank you so much, Camille. It's been a pleasure.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.